Cost volume profit analysis. It estimates how the changes in cost, both variable and fixed, sales volume, and price affect a company's profits. CVP, it's a powerful tool for both planning and decision making for management. And in fact, it is one of the most versatile and widely applicable tools used by managerial accountants to help managers make better decisions. And companies use this analysis to help them reach important benchmarks, such as the break-even point. What is the break-even point? Well, the break-even point is where total revenue equals total cost. So that means zero profit. We're at zero. So put another way, it's the level of sales at which contribution margin just covers the fixed costs, and consequently net income is equal to zero. So since new companies typically experience losses, negative operating income, so when you first start out you typically don't make any money, you lose money. Initially, their first break-even period is significant in their history of their company. So besides break-even points, CVP analysis can address many other issues, including the number of units that must be sold to break even, the impact of a given reduction in fixed costs on the break-even point, and the impact of an increase in price on profit. So it can give you a lot of different information that can help managers and managerial accountants make decisions for future reference, for budgets, for all kinds of decision making in the company. So the basis of a CVP analysis is the contribution margin income statement, calculating break-even point in units, calculating contribution margin ratio and variable cost ratio, and calculating the break-even point in sales dollars. So we're going to take a look at contribution margin and what is that. So it's the difference between sales and variable expense. So if you look at sales and you take away variable cost, that's the contribution margin. And if you take away the fixed cost from contribution margin, you get operating income. That's it in a nutshell right there. So how do you prepare a contribution margin income statement? So this is an example that is in your book, but I thought it was applicable to show you in case you did not see it. Whittier Company plans to sell 1,000 mowers at $400 each in the coming year, and the product costs include as follows. So the variable selling expense is a commission of $20 per mower, and the fixed selling and administrative expenses totals $30,000. So there's all your information. And how you prepare it is it's required you calculate the total variable expense per unit, you calculate the total fixed expense for the year, you calculate the unit contribution margin, and then you prepare a contribution margin income statement for Whittier for the coming year. So this is how you do it. This is the solution. So the total variable expenses per unit. This is how you come to that with that information that I just showed you. 180 plus 100 plus 25 plus 20. That equals $325. Those are the variable expenses. That was my phone, not my doorbell. The total fixed expenses equals the fixed factory overhead, fixed selling and the administrative expense. That's $15,000 plus $30,000. That equals $45,000. So the unit contribution price equals price minus unit variable cost. That's $400 minus $325, and that equals $75. And here it is illustrated. The total, and then per unit. and this is for the coming year for Whittier Company. So this gives you an illustration. So the total contribution margin is $75,000. That's the sales, 400 times 1,000 mowers, which is 400,000, minus the variable expenses, 325 times 1,000. The contribution margin is that $75,000. So the break-even point in units. If the contribution margin income statement is recast as an equation, it becomes more useful for solving CVP problems. The operating income equation is operating income equals sales minus total variable expenses minus total fixed expenses, as illustrated here. So notice that all we have done is remove the total contribution margin line from our contribution income statement. And since it is identical to sales minus total variable expense, and this equation helps us in all cost-profit variance analysis. And in fact, if you can think of it as the basic CVP equation. So it's the basic CVP equations right here. This should help you with your homework. That's why I'm doing all this. We can further expand the operating income equation by expressing sales, revenues, and variable expenses in terms of unit dollar amounts and the number of units sold. More specifically, sales revenue equals the unit selling price times the number of units sold, and total variable costs equal the unit variable costs times number of units sold. So the break-even point tells managers how many units must be sold to cover all the costs. Once more than the break-even units are sold, and the company begins to earn a profit. So these are the basic CVP equations. So here's another example of how to calculate one of your problems. This is how to calculate the break-even point in units. So this is again referring to Whittier Company with the information from the previous problem. It's in example 7.1 from previous. You recall that the mowers sold for $400 each, and variable costs were $325. Total fixed costs were $45,000. So it's asking us to calculate this. Calculate the number of mowers that Whittier must sell to break even using the operating income equation that was just on the previous page. Calculate the number of mowers that Whittier must sell to break even using the contribution margin equation that was just on the previous page that I showed you. And check your answer by preparing a contribution margin income statement based on the break-even point. So here's the solution. This is how you do that. Fairly simple once you have all of the information. Not going to talk all the way through it, but this is how you do that. So the contribution margin income statement based on 600 mowers. This is what it is. 600 is the break even in units. And that's how you get there. Operating income, price times units, minus variable costs times units, minus total fixed costs. So how to calculate, again, the break-even point in units. Here it is in a table. Indeed, selling 600 units does yield a zero profit. So if they sold 600 units, they would come back to zero. Break even. Break-even units are equal to the fixed cost divided by the contribution margin per unit. And here's that calculation. Managers using the CVP analysis may use sales revenue as a measure of sales activity instead of units sold. A unit sold measure can be converted to a sales revenue measure by multiplying the unit selling price by the units sold. So this is how you do that. Sales revenue equals price times units sold. So in the previous problem, 600 units times 400 per mower equals 240,000. So that's the break-even number in sales. So 600 was the number of units we had to sell to break even. If the selling costs were 400 per unit, the break-even in sales amount would be 240,000. Variable cost ratio and contribution margin ratio. So any answer expressed in units sold can easily be converted to one expressed in a sales revenue. So a variable cost ratio, price minus variable cost per unit, equals $10 minus 6 is $4. Variable cost times units sold, $6 times 10 units equals $60. Variable cost per unit divided by price, 6 divided by 10, 60%. So any answer expressed in units sold can easily be converted into one expressed in sales revenues. So that's how you do that. Contribution margin ratio. Here's how you do that. Total contribution margin, $40 divided by total sales, 140%. Alternatively, contribution margin per unit, $4 divided by price, $10, 40%. Here we are with Whittier Company again. How to calculate the break-even point in sales dollars. Whittier Company plans to sell 1,000 mowers at $400 each in the coming year. Total variable expenses per unit is $325. Total fixed expenses $45,000. So here it's telling you some different information, telling you what they want you to do. Calculate the contribution margin ratio, calculate the sales revenue that they must make to break even using the break-even point in sales equation, and then check your answer by preparing a contribution margin income statement. Here's the solution. Contribution margin per unit equals price minus variable cost per unit. $400, I gave us that information before, minus $325 equals $75. Contribution margin ratio equals contribution margin per unit divided by price. So $75 right here divided by 400 right there. So 75 divided by 400 equals 0.1875 or 18.75. Contribution margin ratio comes out cleanly to 4 decimal places. Don't round it. And your break-even point in sales dollars will yield an operating income of 0 rather than being a few dollars off due to rounding. Then to calculate the break-even point in sales dollars, here it is again, break-even sales dollars equals total fixed cost over contribution margin ratio. Can't speak. Contribution margin ratio, 45,000 divided by your 0.1875 equals 240,000. Contribution margin income statement based on a sales of $240,000. Here it is nice and neatly in a table. So indeed, sales equal to 240,000 gives you a 0 profit. So that's what they would have to sell in order to come to 0. So that is what we're going to go over with the CVP analysis. Now I want to talk a little bit about going into Chapter 8. We're going to talk about short-run decision making and what it consists of. It consists of short-run decision making consists of choosing among alternatives with an immediate or limited end in view, and they are sometimes referred to as tactical decisions. because they involve choosing between alternatives with an immediate or limited time frame in mind. For example, accepting a special order for less than normal selling price to utilize idle capacity and to increase this year's profit. If you have something you want to get rid of, idle capacity. If you want to do a year-end sale to increase this year's profits, that is short-run decision making. Some decisions tend to be short-run in nature, short-run decision making. Short-run decisions often have long-term run consequences. So managers need to keep that in mind. Managers face a decision of whether to make a particular product or provide a service or to purchase it from an outside supplier. Make or buy decisions are those decisions involving a choice between internal and external production. Make or buy decisions, that's part of your homework this week. Here's an example. Swazi Manufacturing needed to determine if it would be cheaper to make 10,000 units of a component in-house or to purchase them from an outside supplier for $4.75 each. Cost information on the internal production includes the following. Here it is. Fixed overhead will continue whether the component is produced internally or externally. That will not change. No additional costs of purchasing will be incurred beyond the purchasing price. So what are the alternatives? Wants us to list the relevant costs of internal production and of external purchase. Which alternative is more cost effective and by how much? So now you assume that the fixed overload includes 10,000 of a cost that can be avoided if the component is purchased externally. Which alternative is more cost effective and by how much? So here's the solution. There's two alternatives. Make the component in-house or purchase it externally. Relevant costs of making the component in-house include direct materials, direct labor, and variable overhead. Relevant costs of purchasing the component externally include the purchase price. Here are all the details of figuring that out. And you come to that decision. To purchase it outright would cost $47,500. To make it would cost $38,000. The difference cost versus make, it is cheaper by $9,500 to make the component in-house. Here is an alternative view. The avoidable fixed overhead. Some other things are added. Now it's cheaper to purchase the component. Special order decisions. Company may consider offering a product or service at a price different from the usual price. Firms have the opportunity to consider special orders from potential customers in markets not ordinarily served. Special order decisions focus on whether a specially priced order should be accepted or rejected. These orders often can be attractive, especially when the firm is operating below its maximum productive capacity. So from time to time, a company may consider offering a product or a service at a price different, like I said, different from its usual price. And they just have to make the decision on whether that will be good for the company. Here is an example. Leibniz Company has been approached by a new customer with an offer to purchase 20,000 units of model TR8 at a price of $89 each. The new customer is geographically separated from the company's other customers, and existing sales would not be affected. Leibniz normally produces 100,000 units of TR8 per year, but only plans to produce and sell 75,000 in the coming year. The normal sales price is $14 per that's wrong, per unit. Unit cost information for the normal level activities as follows. So fixed overhead will not be affected by whether or not the special order is accepted. This is what it's asking for. Relevant costs and benefits of accepting the special order include the sales price of $89, direct materials, direct labor, and viable overhead. No relevant costs or benefits are attached to rejecting the order. If the problem is analyzed on a unit basis, operating income would increase by $34,000 if the special order is accepted. So would you accept that? Of course you would. So that's the end of my presentation. It was a little long this week. I hope you stayed till the end. Sorry for how long it was. I usually like to keep it about half of this, but I thought it was worth going over all of these different scenarios and different problems, and tried to give you some examples. So again, if you have any questions, comments, you can email me, text me, call me, and I will be available. Hope you have a good rest of your week. Thanks.